Cyclical declines of 15 to 25% are common in secular bull markets. The truth is that volatility is part of the DNA of gold bull markets.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is the president of U.S. Sprott Holdings, Rick Rule. And also joining us, co-hosting with me today, is Andy Schectman. Rick, thank you so much for joining us today.
Always a pleasure. Thank you for having me back.
Yeah, much appreciated, Rick.
Definitely. And thank you so much, Andy, for being here as well. And the first topic I wanted to pose to Rick was the precious metal markets. We've seen quite a dip, and I know we've talked before. You've said that really you would like to see precious metals go lower because then it's a buying opportunity. So what do you make of this current pullback we are seeing?
It amuses me that it unnerves people so much. People who at a higher gold price were full of conviction, but now that they have the opportunity to exercise their conviction more cheaply, rebel against it. In previous discussions, Elijah, I've referred you to the Barron's Gold Mining Equity Index, which admittedly is an equity, not a metals index. But it's instructive to look at that index in the context of the perturbations in the gold market. Gold bull markets, I've been through two in my life, are of substantial duration, generally 10 years, and great dimension too. The 2000 to 2010 bull market saw the gold price go from $250 to $1,800 an ounce. I'm not saying that past is prologue, but depending on how you measure, we're 4 years into this one, and the gold price hasn't doubled. If nobody has any real certainty in the world, but I would suggest that the probabilities are that we are in a gold bull market of at least similar duration. I say this for the reasons that we've gone over before. Quantitative easing, otherwise known as counterfeiting in plain English, debt and deficits, and negative interest rates. If people believe that those three factors will likely take the gold price higher, and they study history, they will see that cyclical declines of 15 to 25% are common in secular bull markets. People try and put a reason on it. The virus, the cure, Biden. It doesn't matter. The truth is that volatility is part of the DNA of gold bull markets. And if people believe in the reason behind the gold bull market, and they have an oversized gold in their portfolio, what this circumstance really is, I would suggest, is an opportunity to exercise your beliefs more cheaply.
I'd like to just to comment, and you know, I've often said there's very, very few, if anyone, in this industry who is able to articulate things quite the way that you do, Rick, and I really take a lot from what you said. You mentioned that the volatility is in the DNA of a gold market, and I would argue the people who follow this market in general seem to be, at least on the periphery, not the people who understand it for the right reasons, but the people who are most vocal are those that are very emotional as it pertains to a gold bull market. We don't really see that type of emotion that you would think in a traditional equity portfolio. For whatever reason, there's a tremendous amount of emotion as it pertains to gold. And I guess what I'm getting at is that the rhetoric that we've been seeing lately of gold being replaced by, as Wall Street is calling Bitcoin, the new gold 2.0. I think part of the emotion lies in the fact that certainly Bitcoin is approaching its all-time highs, and gold touched briefly 2,100 and has fallen back down. Today, obviously, we see a very nice rebound. But I guess my point to you, or my question to you, is do you view Bitcoin as a alternative to precious metals, to gold? Do you view it as gold 2.0, or do you view it just as a speculative investment?
I think it's probably complementary to gold. I think it probably competes for buyers at the margin, but I think they're very different products. Bitcoin started off as an anonymous medium of exchange, but it's turned into a speculative vehicle. It's too volatile to be used as a medium of exchange, because if you buy something with it, you don't know what you paid for the item that you bought, and the merchant doesn't know what he or she received for the item that they sold. So Bitcoin's functionality as a medium of exchange has been obviated by relatively low liquidity, certainly low liquidity relative to gold, and extraordinary volatility. So it's come down to a speculative vehicle whose the thesis with regards to the store of value is interesting. It's in effect the network effect and the anonymity. It certainly has real utility. As an example, if you're in a country with blocked currency and you want to get it out of that currency, that's a wonderful utility. But I would suggest it's a very different vehicle to gold. There is a crossover in the sense that at the margin, speculators interested in both substances look to volatility. It's interesting that Bitcoin is getting a lot more attention now that it's doubled. In other words, where arithmetically it's precisely half as attractive. And gold was getting more attention when its price was up by 50 or 60%, which is to say when it's 50 or 60% less attractive. So there certainly is a crowd that is more momentum oriented, and a crowd too that relies on price affirmation in terms of their ability to adopt to a narrative. What we're seeing at Sprott with regards to interest in gold is much deeper and much more fundamental. We have been approaching the largest institutional investors in the world for 10 years. And what we're seeing now isn't merely an interest in the narrative, but rather adoption. Some of the very large governance consultants are now recommending a 3% holding in gold among the largest institutional investors in the world, which is very different than the circumstance we saw 2 years ago, where despite their great educations, the managers at the biggest institutions in the world couldn't spell gold. So I wouldn't be too concerned about disintermediation from gold to Bitcoin, except on the wildest margins. I think they have their own utilities, and I don't think they compete at all, except for the marginal speculator. They perhaps compete at the Robinhood level.
Just as a brief follow-up to your comment, you often mention a 0.5% allocation to the investment matrix. When you see a 3% recommendation by the wealthiest people in the world to their funds, would that indicate a six-fold increase in the number you're talking about, or is the number that you talk about often of a 0.5% more indicative of the average person in the country in their investment portfolio?
The 0.5% is everything. I believe it was J.P. Morgan Chase's estimate of the market share of precious metals and precious metals-related assets, including equities, relative to total savings and investment assets in the United States. So that takes everybody from the Harvard University endowment all the way down to the pimply-faced Robinhood holder. The 3% number that I'm referring to is the number that has been described among institutional governance consultants as an appropriate level in a pension fund or a university endowment. And this is an enormous sea change. Andy, since you mentioned the 0.5% market share, for those of you who haven't heard our previous interviews, it's worth repeating that the 3-decade mean market share of precious metals and precious metals related assets is between 1.5% and 2% of total savings and investment assets in the country. So gold doesn't have to get to 3% at all. It needs to revert to mean. If it were to revert to mean, demand for precious metals would approximately triple in the largest savings and investment market in the world. And that's sort of what I think is going to happen.
Now, we had quite a few viewers submit some questions for you. And one of the viewers is wanting to know, his name is Brian, and he's looking into mining stocks and also royalties. And he's saying for a long-term self-directed retirement account, would you prefer large cap producers or top royalty companies?
Interesting question. I'm not sure that it's either or. And it really depends on how much work the individual wants to do in terms of his or her own IRA. Certainly at least two, and perhaps of the royalty and streaming companies. I'm thinking Wheaton, Franco, and Royal, or even Osisco, fit nicely in a lower risk, higher beta account. Some of the larger mining companies, and examples would be Barrick and Agnico also fit in there. You have more upside torque with the operating companies because as higher cost producers, increases in the gold price increase their free cash flow margins more. On the other hand, you have more downside protection in the royalty and streaming companies, which often operate on 80 or 85% operating margins. So I realize it's a question where the gentleman wants a one-size-fits-all answer. The problem is that there aren't any one-size-fits-all answer with 7.7 billion people on Earth.
Definitely. And I think that's a really good answer is that, yeah, it's definitely different for every person. It's definitely different for every person. And Nick is wanting to know still about mining stocks. When valuing mining companies, in your experience, what is maybe the most overlooked yet important aspect?
Net present value, the hardest number of all to get to, is the most overlooked simply because people's eyes glaze over when they have to try to ascertain it or when somebody explains it to them. The delta between net present value and enterprise value is the most important single metric in any producing business. And you don't have to worry about getting the number correct because you never will. You just need to get closer than your competition does. Net present value involves making forward-looking assumptions about the gold production, the operating cost, and the general administrative cost on a going forward basis. You can choose your price point. I usually use the forward strip, but sometimes I test it higher and lower to get a range of outcomes. And to the extent that the net present value of future cash flows is in line with or higher than the current market price at the current strip price for precious metals, traditionally those have been pretty good buys. There are other factors that you need to look to in those circumstances, but we don't have time in the course of today's interview to get into them. With regards to the smaller companies, the companies that aren't yet producing, and maybe even the explorers, the single most important metric, sadly, is twofold. The first is the qualification of the management team. Have they been successful in the past, and is their success related directly to the task at hand? The second is the unanswered question. In development stage companies, there is always one primary question in front of management team that will lower the level of uncertainty that the market has with regards to the value of their assets. And ascertaining what the most important unanswered question is, what is the right path to answer the unanswered question, how much time it'll take, and how much money it will take, is the single most important determinant of success or failures in the speculative end of the market. Unfortunately, most speculators just pay attention to price. Having price information without having an opinion of value is absolutely useless.
Definitely. Moving now to this viewer from northern Indiana, and he's wanting to know about the mining stocks and also the physical metal, what you see peaking first as we move into this, through this gold market. Do you see precious metal, like the physical metal, peaking first, or the mining stocks?
Well, certainly in terms of their relative relationship, gold is well ahead of the mining stocks at present. And that's normal in the early and mid stages of a bull market. The first buyer in a precious metals bull market is always a fear buyer. And we've definitely seen that in gold. That isn't to say that we haven't had speculative buyers at the margin. But the real buyers have been people who are afraid of the purchasing power of their savings in fiat instruments. The mining stocks play catch up. And I would suspect, with no reason to suspect it except experience through two prior bull markets, that gold will continue to lead the gold stocks for another year and a half. But my suspicion is that when you see gold on the cover of something like Bloomberg Business Week, then you will see wide enough adoption of the gold thesis that you will see a broader base adoption of the gold stocks, and they'll begin to lead. The blow-off market, when that happens, and I guess I need to say if that happens, the blow-off market will be all about the stocks. The people who come in at the end of the market are really narrative obsessed and really price obsessed. Certainly when things get absolutely positively crazy, what you're going to see is the beginnings of disinvestment in gold by the fear buyers. When the gold price gets ludicrous, I hope I'm among them. And a wholesale move by the generalist institutions and by the Robinhood crowd into the gamiest of the gold stocks.
So where do you put your money, Rick, when you're one of the few that are disinvesting? When you disinvest from a primary bull market in metals, if you had to take a guess, do you find the value in real estate? Do you find the value in blue chip stocks, maybe paying a dividend? I guess the reason I ask is it's such an unusual time where you have arguably a bubble in real estate, a bubble in stocks, and a bubble in bonds all at the same time. Where does one go? Where would you go, do you think,
Andy,
at a period of time where you're disinvesting?
Andy, if you make the assumption that we are 4 years into or 5 years into, depending on where you started this gold bull market, a market that has 10 years duration, to answer the question, I would have to know what is unloved and cheap 5 years from now, which I can't know. If I felt the gold market was overvalued today, and I don't, I would be looking at very high quality farmland in the upper Midwest. I would be looking in the oil and gas space. I would be looking in the oil transport and dry bulk shipping space, a market off 90% in real terms. And I would be probably beginning to be more actively involved in the uranium space. But it really depends on, what feels relatively attractive to you. I was able in 2010 to go into the community bank stock space, which everybody in the United States hated. They thought there'd only be Citicorp and Bank of America and a few big banks, not understanding that while the well-run community banks can't compete with the big guys can't compete with the little guys either. And that worked out very, very, very well for me. People have figured out that game, and banks that were trading at 80% of depressed book are now selling at 250% of not depressed book. So that game is all gone. But my life is really about what is hated, or at least what is boring to people, and what are businesses that have absolute pricing power. In commodities, you look for a commodity that is important to our way of life. Copper, oil and gas, agricultural chemicals, where you know that they're going to be in demand 5 or 6 years from now, Ms. Thornburg notwithstanding, and where they're selling, that is, the selling price of the commodity is less than the total cost of production. Then all you need to understand is that either the price goes up or the way of living that we enjoy changes, and it's much more likely that the price goes up. So it will really depend on what is cheap and what is hated when I believe that I've outlived my usefulness in the gold trade, or rather, that it's outlived its usefulness to me.
And so all those types of alternatives, whether it be exposure to farmland through some sort of a product, a Sprott product, or exposure to uranium or to copper or what have you, to oil and gas or to the transportation, these are all things that Sprott is able to help their investors with as well, so that you'll be able to help people like myself and others out there transition from one place to another, correct?
Well, I've been buying shipping stocks myself. I don't know enough about the sector that I'd be willing to burden clients with my knowledge. Certainly in terms of farmland and uranium and things like that, extractive industries, I'm comfortable enough that we can help people. I'm busy trying to understand more about the shipping business, but at present I'd rather risk my capital than my reputation. So with the exception of shipping, yes, absolutely, we can help.
Before we let you go, Rick, I just wanted to touch on one last viewer's question, because you did mention oil and gas, that industry. Maria is wanting to know, are you bullish currently on oil and gas? Because you mentioned how the things to be looking at, some of the things to be looking at are things that people will always need. And obviously that's something that is very stable.
I wish she'd asked me the question 4 weeks ago. You know, we've had a tremendous rebound in the oil stocks. The indexes are up 25, 30%. Yes, I'm attracted to them in the 2-year time frame. No, I'm not attracted to them in the 3-month time frame. I think they need to digest their gains. I could see it taking 2 years before the oil price increases, but I could see the market anticipating the increase. What's lovely about the oil stocks? Well, two things are lovely about them. First of all, the price has to rise. Not everybody's going to own a Tesla. Peak oil demand is going to occur sometime like 2030 or 2035, and supplies are falling rapidly as a consequence of low price. So either the price rises or your car doesn't start. Those are the two choices. Guess what's going to happen? The second is, in terms of themes that have long lead times, where you go wrong is time value of money. And the big oil producers and some of the intermediates pay very, very, very nice dividends. And the wait is much more pleasant if you're getting paid 3%, 4%, 5%, or 6%. In other words, your time value of money in today's interest rate environment goes negative. You actually get paid to hold these things. So I like the oil stocks for those two reasons, but they will certainly be volatile, and they will also try your patience. Patience is one thing I still have in abundance.
That's very good. And coming full circle here is, just that need for patience, especially as we're seeing gold and silver sell off a bit. It's rebounding today, Tuesday. But just kind of looking more at the long term.
Elijah, it's important that people understand why they own gold. It's important that people don't merely look at the price, but they look at the reasons why the price might be going up and what utility it might have for people in their own portfolio. If people have the psychological and financial staying power, they will be able to, like me, look at a circumstance where the gold price is down by 12 or 13% and the equities are down by 25% and say, oh my goodness, a sale. I'd like some of that. Isn't it nice to see it cheaper? Where people are perhaps overpositioned in gold because they bought the narrative, or where they don't have the courage of their convictions, they don't have the psychological staying power, a circumstance like this is, of course, trying. I've been saying for many, many, many years in extractive industries, including gold, you're either a contrarian or you're going to be a victim. And so it's important that people right-size their portfolios and that they also right-size their mindset with regards to gold.
Definitely. Well, Rick Rule, thank you so much for your time today. Before we let you go, if you'd like to share with the viewers any last thoughts, and how do people find you online?
I would love to do that. We have enjoyed talking to the Miles Franklin customers, and we're giving them an incentive to do it. I personally will review any of your listeners' natural resource portfolios who want them reviewed. Simply go to a website, sprottusa.com/rankings. Enter your natural resource stocks only. No pot stocks, no bank stocks, no supermarket stocks. And I'll rank them 1 to 10, 1 being best, 10 being worst. And I will also comment on individual issues where I think my comments might have value. If you include charts in the request, I will send you the Barron's Gold Mining Index chart, not for technical analysis. It's really a visual aid to understand the anatomy of prior bull markets. And I'll include a 100-year commodity chart so that you can see just how cheap physical commodities are relative to other asset classes going back 100 years. Once again, the website is sprottusa.com/rankings.
I urge all of our listeners to take Rick up on that. I've done this for 30 years and have not met anyone that I would trust more than Rick Rule or any of the qualified brokers at Sprott and Carlsbad. So, Rick, thank you so much for making that generous offer and for coming on the show. We appreciate it very, very much.
Thanks for the opportunity and the kind words.